G'day investors, it's Peter again. Back to Pete's Investing. No bull dust trading, just simple, reliable trading ideas. But first, our disclaimer. Please feel free to take your time and read this carefully. This is not offering advice or recommendations or holding positions. Past performance and what we're showing is no guarantee of future results, and it's purely an educational video series to better educate you in your investment strategies moving forward. Today's exercise, we're going to be looking at what happens if price goes against you. Do you stop out? We're going to be looking at the average down strategy. Peter again, just doing a follow-up from the recent simple trading strategy video. We're just going to recap that. So here I've done redrew the diagram in terms of where we entered and where we closed. And remember, the entry point was when the CCI moving average 20 crosses over the zero line, and the moving average of the price is in an uptrend, we enter the trade. So here we entered the trade here at 65.17, and what I've done here is moved, it's showing down here the target price. Now let me just get that right. So 66.07 is our target price, and that happens to be on that line there. So our exit strategy, so again, the moving average to buy, moving average 200 is an uptrend, and the moving average of the CCI 100 beginning the uptrend, which I've just shown. And the trigger to sell is when the moving average closes or breaks the uptrend, and the close is greater than the close it. And the close it is actually this calculation here. I'll let you freeze the video and digest that. But basically what it means is the price down here, if you look at that there, where we bought it, says 91 overall, 91 points. So 91 points on top of the close is a target price of 6,609, 66.09. And that's where we get to roughly around that area there, 66.09 point. So if the price reaches at least above that, we want to get that much profit in our trade. And also when the moving average 200 breaks into a downtrend. Now, break into a downtrend there and there as well, but it didn't close out. Why? Because we're still in that band. And again, this band is required for us to make a profit. We don't want to break out when it's just over that price, because that'll give us very little, if any, profit. We want to make a profit based on the average high-low range of the previous 90 bars. And that's what that gray area represents, which is calculated in this area here. So even though it's gone up and the moving average breaks in a downtrend there, it's still in the trade. Keeps going, breaks above the first criteria, which is above this high-low range. So now we're ready to exit if the moving average breaks an uptrend into a downtrend. Keeps going, and as you can see here, the price starts going down, the moving average 200 starts breaking down, and it breaks into a negative or a downtrend, hence we close out. So we get out of the trade there. And that gives us a nice little profit from where we began. So that's a simple buy low, sell high strategy. That's a recap of the previous video. So going back to now, what this video is primarily aimed at is, let me get this size properly. So here I've done a similar sort of exercise. We enter the trade. So the average down strategy is we're already in an open position. So here we enter the trade, one position, and the price and the moving average 200 doesn't break above our first condition. The price starts turning down against us. Okay. So where do we enter again? So the reason we enter down here and not up here anywhere is because of this criteria. These three conditions need to be met. The close needs to be less than the average last price. So the close anywhere down here needs to be less than this price we entered at. And this anywhere along here would have been meeting that first condition. The second condition, the the CCI 100 moving average 20 needs to resume in an uptrend. So this CCI 100 needs to break the above there, and as you can see, these spikes indicate where we could have entered, but we haven't entered because the gap isn't greater than the gap 2. So the gap 1 and gap 2, this is a calculation. So it's basically gap 1 is the average last price minus the close. So average last price minus this latest close. That's the first gap 1. And gap 2 is 2 times the MAS2. And the MAS2 was, as per the sell criteria, the average of the last 90 bars of the highs lows. So 2 times gap MAS2. And that's why we need to have a entry point down here. So we enter more contracts there, and that now gives us, similar to this calculation up here, this gray zone, it gives us this is a new average price. So if you look at the average price, we entered 8 contracts at 61.84. So 61.84, we entered 8 contracts. We entered another 8 contracts at 59.27. So it's 59.27, we entered another 8. And that brings the average price to 60.55. And that's what that black line there represents. 60.55. So what we're doing now is we're trying to determine the high-low range of the previous 90 bars and estimate based on, that's our average. So if we break anything above that line, that's our break even. We need to break above that line to make a profit. And we're saying we want to make the gap or the target price anything above this gray area, which is calculated based on the gap. So remember our exit criteria. Our exit criteria as per the single trade, it's the same. The MA200 must be closed or break into a downtrend, and the close must be greater than the close it. Remember, close it was this calculation. So this is our close it range. So it's above that, yes, and the moving average is a positive. So let it keep going. That's the reason we're following the moving average 200. And there it just breaks above the moving average 200 breaks. So we close out both positions at 64.74. So had we traded 8 contracts, we would have made, so the total there was 109,212. Back when we opened the position about a month, about 30 days ago, we opened with our account value at 102,507. It's about 6,700 points. Okay. So that's based on 8 contracts. So depending on how many contracts you traded, that's the profit you would have made. So that's the average down strategy. So if that had kept going against us, you can see the overall happened another time here, multiple moving average downtrend, entered the first time there, second time there, and it closed down at a profit there, entered there, trade another one there, closed at a profit, and these two are single trades, which is the one we demonstrated earlier. There's another one here, another one here. And this one's still going. So we entered here, and as this is still going on a sideways market. Thank you for watching. To get notified of all future videos, be sure to subscribe and click on the notification bell below. See you next time, guys. Happy investing.